Seeking to combat manipulation and speculation, the Commodity Futures Trading Commission proposed overnight restricting the number of commodity futures and option contracts that any one investor can hold in energy, agriculture and metals derivatives. Let's get a view on this now and how it may affect the sector and your investments. Jonathan Barratt, Managing Director at Commodity Broking Services, joining us from Sydney. We were talking about this yesterday, looking ahead to what might happen from this commission. One of the fears was mainly on oil and energy trading, it seemed to be, rather than agriculture. What did you make of what came out of that?
Oh, Karen, look, I think it's been an issue, and it's been a contentious issue that we've had for a very long time. Where you get funds actually holding a large proportion of the open interest that really have nothing other to do than rather just to speculate. I actually feel that it is positive to try and curtail it, but it doesn't allow for the freedom to trade and the freedom to invest. Remember, in futures, for every buyer there is a seller. So in terms of just restricting the size that you're actually allowed to hold, I think is probably a negative thing. And I think they'll probably find it a little bit tough trying to actually get that through. So I think if it's contentious, it's been contentious for a while, and I'll probably suggest it's going to remain like that for the foreseeable future.
Jono, can we liken this to during the global financial crisis when we saw some bans on short selling? The implications were a removal of liquidity in some of that market. Could this be one of the ramifications if we see regulators active in the commodity space trying to drive out speculators?
Well, yes, we are, Karen, but we're seeing this across the board. Regulators involved and governments involved in the commodities space. And we've just seen it on the commodity space where governments, particularly in India, have been involved in whether it's speculation or whether it's hedging, you don't know, but they're involved in the market as well. So when you look at the amount of regulatory involvement, it does become an issue, because if it does have the effect of increasing or decreasing the amount of supply and liquidity, then you'll probably see more volatility in the market. And we don't need to see more volatility in the market because it's extremely volatile at the moment.
If we are going to see changes, then, Jono, does this make you somewhat wary about investing in the medium term in commodities?
Look, I think it doesn't make me concerned at all. I mean, when you look at where commodities are heading, they still fundamentally come back down to supply and demand. And the price will move in accordance to that. What we have noticed over time is that the expectations are now, and the volatility is a lot higher. Expectations in terms of where we see prices should be have actually sort of gone too far. When we expect supply and demand would say the price should be here, like for cotton, for instance, when it's at record highs, we see the involvement of the speculator pushing it out beyond where it should actually be. And I think that's the concern. But in the market, we just have to work out where that expectation will be. And if it's 10 to 15% above supply-demand scenarios, then so be it. We still need that liquidity in the market to be able to hedge and trade.
Jonathan, it's Adam here. I'm just wondering, I mean, they're going to restrict the number of positions that traders can hold. But what about moving the margins in terms of the margin limits? Because, I mean, we saw similar moves in the Shanghai Futures Exchange. Wouldn't that do the trick?
Well, we've seen that already. Adam, when we've looked at the increase in initial margins in the commodity space, we have seen it, particularly in the wheat market and also the sugar market, where the CFTC actually move the margins higher, and they actually have quite a complex formula behind it in order to stop people trying to corner the market, because the initial margins is one that will stop people, but then again you can't inhibit people to wanting to hedge. And if the price of the margin stops people to hedge, then you have more risk in the market, and you're not taking that risk out of the market, which the hedgers need. So I don't think that's a solution. It's certainly a mechanism to slow down the way the market moves, but it certainly won't help the market or won't help those hedgers that need to hedge by increasing the initial margin. Of course, it reduces their cash flow. So it is a very complex area, Adam, and I think there's still going to be a lot of discussion as to what is the correct procedure to follow.
Jono, we were talking to a US trader before who was telling us he's a buyer of gold at these levels. We had a pullback overnight of about 1%. How are you feeling about the gold market?
Karen, as I mentioned a little while ago, I thought we were at a high for gold for the interim. I was pipped by about a couple of dollars when we went to that high just the other week. Look, in my mind, it's broken an area of support that could see it back to that 13.35 and maybe a little bit lower. It is interesting to see that I think investors, and when I look at the SPDR, there's been a steady stream of sellers throughout the week, and that's continued to keep a cap on any movement higher. So the investor market, those people that went to gold cause of financial concerns, are actually starting to move away from it, particularly as they see the US economy starting to pick up, and as a result of that, the US dollar starting to firm. So it's not as shiny as it used to be, and perhaps we're in for perhaps a deeper correction for gold.
All right, top. John, I've got to go. Great to talk to you. Happy holidays. We'll see you bright and early next year. Jonathan Barratt, Commodity Broking Services, live from down in Sydney.